Hello, Mr. Kong. Today our group is talking about AirAsia company and their financial analysis. Our group member is Ma Haijun, Li Wenchang, Chen Lei, and Chen Chen. Now we can see the organization structure. The chart shows us the corporate structure and the principal operating companies for the AirAsia, which has the domestic and an international. And for the AirAsia background and founder, AirAsia has flown over 100 billion guests upon the core belief that now everyone can fly. The main terminal hub is at Kuala Lumpur International Airport, which is KLIA2, Malaysia. And the AirAsia operators schedule domestic, regional, and international flights to over 400 destinations spanning 25 countries. And the AirAsia has 8,000 employees, and they are founded by the 2001. And the company grew from 2 planes in 2002 and to a fleet of 86 aircrafts flying 30 million people. For the AirAsia's vision, they are trying to be the largest low-cost airline in Asia and serving 3 billion people who are currently underserved with poor connectivity and high fares. And their mission is to be the best company to work for wherever whereby employees are treated as part of the big family and create globally recognized Asian brand to attain the lowest cost so that everyone can fly with AirAsia, and they maintain the highest quality products, embracing technology to reduce the cost and enhance the service level. So for the AirAsia values, which has 6 key strategies, which is safety first, higher aircraft utilization, low fire, no freeze, and streamline operations and lean distribution systems, and also the point-to-point and their strategies is a safety, low fire, service, and the simplicity. And the foundation is low cost efficiency, simulating new market and strong cash flow. And we also can see the AirAsia achievement at 2011 too, and also 2012. Now, the AirAsia today is got 6 social aid companies, which is AirAsia UK, AirAsia X, Thai AirAsia, Indonesia Air, AirAsia Philippines, AirAsia Japan, and AirAsia X is previously known as Fly Asian Express, is focusing on the low cost, long haul segment, and established in 2007 to provide high frequency and point-to-point networks to the long haul business. The AirAsia X is the spreading its wing to exciting destinations such as Australia, China, India, the Middle East, and Europe.
The third part is analysis of the company's latest 3 years financial ratio. All the figure and the data from annual report of AirAsia. Current ratio. From the above information during these 3 years, the current ratio of AirAsia was decreasing. It means that AirAsia's ability to meet its short-term obligation was declined. Quick ratio. From the above information during these 3 years, the quick ratio of AirAsia was decreasing. It means that AirAsia's ability to meet its short-term obligation was declined. Inventory turnover. From the above information during these 3 years, the inventory turnover of AirAsia was decreasing. It means that AirAsia's efficiency of converting inventory into sales or cash was declined. Average age of inventory. From the above information during these 3 years, the average age of inventory of AirAsia was no change. The company's efficiency of converting inventory into sales or cash was almost remained the same. Average collection period. From the above information during these 3 years, the average collection period of AirAsia was no change. It is useful in evaluating credit and collecting policy. Total asset turnover. From the above information during these 3 years, the total asset turnover of AirAsia was decreasing. It means the lower the company's total asset turnover, the less efficiently its asset has been used. Debt ratio. From the above information during these 3 years, the debt ratio of AirAsia was increasing. It means that the company had a greater degree of debt and the more risk. Times interest earned ratio. From the above information during these 3 years, the times interest earned ratio of AirAsia was decreasing. It measures the company's ability to make contract interest payment. Gross profit margin. From the above information during these 3 years, the gross profit margin of AirAsia was decreasing. It means that the company's profitability will decline. Operating profit margin. From the above information during these 3 years, the operating profit margin of AirAsia was decreasing. It means that the company has higher operating expense. Net profit margin. From the above information during these 3 years, the net profit margin of AirAsia was decreasing. It means that the company's costs and expense were not stable. Earning per share. From the above information during these 3 years, the earning per share of AirAsia was decreasing. It means that the company's ability of earning the period on behalf of each outstanding common stock was reduced. Return on total asset. From the above information during these 3 years, the return on total asset of AirAsia was decreasing. It means that the company's effectiveness of management in generating profit with its available asset was declined. Return on common equity. From the above information during these 3 years, the return on common equity of AirAsia was reducing. It means that the return earned on the common stockholders' investment in the firm was declined. This is a summary of AirAsia ratio.
This part I will introduce the activities of the company for the past years which had contributed to the big change in a particular ratios. The first one is gross profit margin. From this table we can know that the gross profit margin of AirAsia decreased a lot for each year, which means the cost of goods sold in those 3 years increased. This is because of 4 reasons. The first reason is in 2012, the airline established new routes from Bangkok to Chongqing, Wuhan, and Xi'an, as well as from Chiang Mai to Macau. At the same time, an increase in its fleet size from 22 Airbus aircraft in 2011 to 27 in 2012. The next reason is in 2012, Indonesia AirAsia introduced 12 new routes. Route expansion was accompanied by the addition of 5 more aircraft to Indonesia AirAsia's fleet. The third reason is in 2013, Indonesia AirAsia introduced the Medan to Jakarta, Bali to Makassar, and some routes. It added 8 new carriers to its fleet, including its first of 4 fuel-efficient Sharklet equipment A320 aircraft in June 2013. The last reason is Indonesia AirAsia kept its fans excited with various promotions every month of the year, with the exception of the peak travel months of June, July, and December. In addition to the free seats promotion, which was held in January and then again in November. The next ratio I want to introduce is operating profit margin. According to this table of proof, we can see that the operating profit margin of AirAsia decreased a lot for each year, which means that the AirAsia had not a good control of its operating expenses. This is because of two reasons. The first one is AirAsia Japan. Following its formal established in August 2011, the first flight for the airline was on August 1, 2012. With the plan's implementation, it produced much operating expenses, such as the staff allowance, contract fees, and so on. The second reason is AirAsia Indonesia. In 2012, Indonesia AirAsia opened its sixth hub in the countries in Makassar.
By analyzing the repayment ability, which is analyzing the carry ratio and quick ratio, the carry ratio is believed to be no more than 2 to 1 and the quick ratio should be 1 to 1 or more. The carry ratio of 2 to 1, which means that carry aside are double carry liabilities. Even though half of carry aside cannot be realized in the short term, but also be to ensure that all carry liability is repaid. Quick ratio of 1 to 1, which means that cash has really realizable the ability of quick aside to carry liabilities is equal. You can always settle all carry liabilities. In 2011, quick ratio is too big. This shows that company cash holding excels 2012 and 2030. Quick ratio is around 1. We can see that AirAsia has good cash ability. However, according to our analysis of AirAsia, we can see that carry ratio is all less than 2 and shows a decreasing trend, which means corporate short-term service is not guaranteed. The company gross profit margin is getting worse during the 3 years. The debt ratio is exceeds 50% and become higher and higher. It shows an increased trend. And when we look at net profit margin, if our company is able to maintaining good sales margin continuous growth, the finance position of the enterprise should say it's good. However, there are very big gap between 2012 and 2030, from 13.5% down to 3.6%. All in all, there are debt ratio, gross profit margin, and net profit margin. It shows that AirAsia has very bad financial position. Return on total assets and return on equity are very useful ratios that analyze of corporate profitability. We can see from the data, return on total assets has been declining. Return on equity have a little bit increase in 2012, but there is a great decline in 2030. In conclusion, we had found that some ratio had growth in 2030, but it has great decline in 2030, such as not profit margin, earning per share, and return on equity. The reason is foreigner exchange loss. In 2013 has lost more than half of net profit in 2012. So according to the data displayed, we can see that short-term investing highly risk. If very interested in, we can consider long-term investment.